Boo! Oh, I gotcha. Day 4, man. Clap it up, clap it up, clap it up. Day 4, let's get it, let's get it, let's get it. Bro, to be honest, you guys are falling off, bro. I'm giving you all the sauce at no cost, bro. Why aren't you guys, like, watching this up like crazy? I don't get it personally, but it's all good, man. Today's gonna be probably drawn liquidity class is gonna be the most important class, but today's gonna be a pretty important class, bro. Part of it's gonna be pretty fundamental, but part of it's also not. So I'm hyped for it, man. Let's do it. One thing I do want to talk about, though, bro, have you ever thought about the fact that, like, everything that you look at, you know, I don't know about taste, but you know what it would feel like on your tongue. No diddy. Like, no diddy. That's, like, the corniest thing ever. But pause, like, bro, like, when I look at my monitor, I know what that would feel like on my tongue. You know what I mean? And, like, this window, I know how that would feel on my tongue. I know what that would feel like on my... Yeah, that felt exactly how I thought it would, bro. You know what I mean? Like, I don't know. It's just something to think about. You know what I mean? But, yeah, man. I mean, let's get into it. Today's class is liquidity and imbalances. There's not much I'm going to cover on liquidity because I want to save a lot of it for the drawn liquidity class. But I have to go over it because if there's someone who's literally brand new watching this, I have to, you know what I mean? I have to go over it. So... let's find a good example. My name is Darius. I'm feeling delirious. I'm just a little curious. Driving the whip, I'm steering this. Oh, wait, hold on. I'm driving the whip, I'm dashing. I drive real good, I'm not crashing. Get a lot of money, I'm stashing. Oh, hold on. If I see your face, man, I'm bashing. Hold on. Alright. My bad. Let me lock in, bro. I'm tweaking. Alright. So, if you're brand spanking new to this trading stuff, bro, and you don't know what liquidity is, if you don't know what liquidity is, I'm about to change your life, bro. Straight up, I'm about to change your life. So, here is the liquidity theory, alright? The idea is that at every single high and low in the market, people have their stop loss orders sitting there. And the idea is that big money wants to hit those stop losses to take those people out of the market to make room for their orders. And the reason why they would want to do that is because, like, big money, they're playing with tens of millions of dollars, right? So if they enter the market with tens of millions of dollars at one time, the market's just going to pump. And, like, as it pumps, their orders are going to get filled individually, so they're not really going to make a profit on the move, right? So, like, here, if big money didn't push to this low to take people out of the market and instead they just bought up, their orders, well, for one, the market would just, like, immediately shoot up in one candle. But as it shot up in one candle, their orders are getting filled as that candle's going up. So their average fill is going to keep going up, and they're not really going to make a profit on it. So that's why they have to take people out of the market to make room for themselves. And when they make room for themselves, it's enough to where it's not going to just absolutely blow up the market. So, and like I said, those buy stops, liquidity is sitting at every single high and low. So this low, you can see what happened. We swept it, hit those buy stops, big money got in, and then we fueled the move up. Then same thing happened here. There was highs here, there were sell stops here. We took it, and then we started our descent. I mean, it's not as big of a move as this, but you can see that we rejected it. It's going to happen like that. Well, I mean, not every single time, obviously, but this happens on every single time frame. Pay attention to the high and low on every single time frame. The higher the time frame, the more significant it is. That pretty much applies to, like, every single concept. But, yeah, man. If you are that brand spanking new and you don't know what liquidity is, this entire YouTube series is about to change your life, bro. I'm not going to lie. No promises, not financial advice. But, yeah. Also, bro, I'm so irritated. I watched back the recordings. This camera makes my freaking beard look mad thin. I swear my beard is thicker than this. But, yeah, bro. Anyways. trying to figure out what else I could say about liquidity. Because like I said, I'm saving all of the draw and liquidity stuff for the draw and liquidity class. So what else can I say about liquidity? I mean, yeah, that's all I'll say about liquidity. The more important stuff is what I'm going to talk about with imbalances, because what I'm about to say with imbalances, it's more than just for value gaps, bro. I'm about to put you on to, like, everything, or all the ways that I use imbalances. But, yeah, that's all liquidity is. It's the highs and lows in the market, whether you're on the hourly time frame or the 15-minute time frame. That's a level of liquidity. 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 All the highs and lows are levels of liquidity. So, like I said, there's more to liquidity than that. There's way more to liquidity than that. If you know nothing about trading, it is not as easy as that. It's not as easy as we get a sweep, you know we can go long. Like, it's not that easy. I'm going to tell you everything you need to know about liquidity in about 2 or 3 classes. That's when we're going to talk about the draw on liquidity. If you are that new to where you've never even heard the term draw on liquidity, my brother, I mean, just get prepared. All I'm going to say is wear some loose pants that day. Wear some shorts that aren't too tight on the genitalia area, because you're going to get very stiff down there when I put you onto this. Alright? Just be prepared. I need you to come to these classes prepared. But yeah, I mean, that's it about liquidity. That's as deep as I want to go right now. It's highs and lows in the market. Each high and low has buy stops. Big money wants to take out those buy stops, because when those stop losses are hit, those people are taken out of the market, then big money comes in. So, and this is considered buy side liquidity. This is considered sell side liquidity. Liquidity to the upside. Wait, no. Other way around. The bottom, liquidity that is to the bottom is sell side liquidity. Liquidity to the upside is buy side liquidity. Okay? And the reason why is because when you are selling, like you guys all know, especially you guys who trade futures, when you sell and you put a stop loss, if you're in a sell, you put a buy stop. Because if you're selling, you have to get out by buying. So that's why it's called buy side liquidity, because buy stops are here. And then obviously the same for the other end. But yeah, that's as much as I want to say on liquidity for now. Got to ease it into your brain. Got to ease it in. If you know what I'm saying, got to ease it in. You never want to go, like, trading is just like real life. You know what I mean? You never want to go straight in. You never want to go in dry. You got to get it ready. And you got to get it ready slow. You got to take your time with you got to take your time with, like, the prep. You know what I mean? Yeah, I mean, yeah, you know what I'm saying. So just, yeah. So let's get into the imbalances, man. Let's get right into it. So there's 3. Hold on, let me think. Yeah, there's 3 things that I want to cover when it comes to, and oh no, there's 4. There's 4 things I want to cover when it comes to imbalances. So, let's get this text tool out. Bro, I don't know what drug I took, but I'm tweaking. What I want to say? Oh, imbalances. Alright. First form of imbalances I want to cover. My mic fell. First form of imbalances I want to cover, and the simplest form, is fair value gaps. The next thing I'm going to want to cover, oh, I guess it's going to be 3, because I can combine these 2, and that would make sense. The next thing I want to cover is new week opening gap and new day opening gap. And the third thing I want to cover is price voids. Alright, so let's start with the easiest one. Write this, if you're taking notes, which everyone should be, write this in your notes, make this like a section, and then leave room to put notes under for each topic. Because I'm going to delete this, I don't want this on my screen. So, first thing, fair value gaps. The rule that you need to know, it is all, down to its bare bones, all you need to know is that the market moves to take liquidity, as I just showed you, the highs and lows, the buys and sell stops. Market moves to take liquidity or fill imbalances. That's all trading is, bro. Everything that you learn, all the concepts that you learn, it's an extension of that simple sentence, bro. The market moves to fill imbalances and take liquidity. So that is why fair value gaps exist. Let's find maybe we should find a high time frame example and then a low time frame example. Actually, no, I'm going straight to the 1 minute. Do you want me? Actually, I'll show the trade I took today, because it'll segue perfectly into the next one. Alright, so fair value gaps are imbalances in the market. It is a 3 candle pattern. I would draw it up, but that's going to take too long. It's a 3 candle pattern. So 1, 2, 3. These 3 candles, are your fair value gap. And the fair value gap, as you would assume, the only gap that is within these 3 candles is this wick's low and this wick's high. So this would be a bearish fair value gap. It's a gap that is formed on a move to the downside. Okay? So a bearish fair value gap, make sure you write this down, bearish fair value gap forms, so the first candle's wick low and the third candle's wick high, the distance between those two is your fair value gap. Okay? And the idea, there's 2 ways to use this. If you, we'll talk about the example that's here and then I'll find another example. But there's 2 ways to use this. You can trade to the fair value gap, or you can use the fair value gap as an entry. So here, it's an example of using the fair value gap as an entry. So I wanted the market to don't be weird, but I wanted the market to go come on baby, I wanted the market to go here. God, why do the candles get so thin I can't see? Do you want me? Wanna love me like that? Like that? Do you want me? Wanna love me like that? Like that? So, this is going to be the next form of imbalance that we cover. So don't worry about what it is or what it means right now. I'm just telling you, I wanted the market to go here. Okay? So this is an example of using a fair value gap as an entry. I want the market to go here. And like I said, actually no, I have to save. Ooh, I have to save it. Oh, I don't want to save it. You know what? I'll tease it a little bit. Don't be weird. I'm saying I'm not going to give you the whole thing. I'm just going to speak. Alright, bro. Just don't be weird. Alright? So, I'm going to leak a little bit of what's going to be in a future class just because it'll make this scenario make sense. So, like we said, the market either moves to fill an imbalance or take liquidity. So, if the market moves to fill an imbalance, it's not going to move to price action that's already balanced, right? So the idea of a fair value gap is that we only trade it down. So the market's going to trade back up to make this section of price balanced. Because if we only trade down, price isn't balanced. It needs to be traded down and up through for it to be balanced. So when we left this gap, that's imbalance. That's a fair value gap. We traded it back up to balance out price, and then we headed towards our drawn liquidity, the new week opening gap, or the new day opening gap. But what I'm trying to get at, and the reason why I put an emphasis on on trading towards unbalanced price action, is you could be wondering, why did we short here and why didn't the market come back up here? That is because price above this point is already balanced. Where's the only imbalance above this fair value gap? This is an imbalance. Where's the next imbalance? Where's the only imbalance after that? If you are not taking notes, take notes. Or if you're not paying attention, I need you to lock in right now, because this is something that nobody talks about, but you need it in your trading because it makes it so easy to decide where your entries are going to be and where your stop losses are going to be. So on this price leg right here, keep in mind, we don't just apply this randomly anywhere. Like I said, price is predisposed to go down. I want the market to go down. So if I want the market to go down, I want to enter at the last section of price that needs to be balanced if I'm taking a fair value gap. in most scenarios. Obviously, like, that's the ideal scenario. It's not always going to be ideal. But above this fair value gap, where's the last imbalance? It's right here. And what do you see? That's already balanced out. So, like I said, if you're wondering why I took this fair value gap and assumed we wouldn't go higher, that's because price is already balanced above this fair value gap. Price is balanced up here, bro. If the market moves to fill imbalances, why is it going to move through already balanced price action? It's not going to in most scenarios. Obviously, sometimes, like if you're like in that scenario, like in this scenario, if our draw on liquidity is higher, obviously we're going to trade through balanced price action to get to our draw on liquidity. But like I said, our draw on liquidity is lower. We want the market to go down. So assuming that we want the market to go down and we have price balanced above this high, it is very, very safe to assume that we can take that 1 minute fair value gap because price is balanced above that and we want the market to go down. So that's what makes this fair value gap safe. And then that wasn't my entry. Wait, was it? No, that wasn't my entry. This was my entry. So that's a fair value gap, and like I said, we pulled up, we balanced it, and then we headed towards our draw on liquidity. So next, I took this fair value gap. This was my entry today. And like I said, some people would wonder, why would Darius, why would you take this fair value gap when there's a fair value gap up there? Because it's already balanced. It's balanced. If the market moves to fill imbalances and take liquidity, why would I be worried about the market going up there if it's already balanced? I wouldn't be. I'm about to freak out. If you're not understanding what I'm saying, I'm going to punch you, bro. On God, I am. Next, I took another short. I added to these shorts. We really got stuffed out on break even on this pullback. But I grabbed another set of shorts right here. Why did I do that? Darius, why would you take this fair value gap when you know that there's a fair value gap above it? Because we already moved up and balanced it. Obviously, there's a section of price up here, but when we're this close to our draw on liquidity, bro, I'm about to freak out. But when we're this close to our draw on liquidity, we're not gonna, like I said, already balanced price action. We're not gonna invalidate all of this right here. We're not gonna invalidate this fair value gap just to get back up and fill that little bit of imbalance. No, bro, we're right next to our draw on liquidity. So we're going to fill the imbalance that's on this leg and then make our descent, bro. The market is not going to trade to already balanced price action unless the draw on liquidity is that way. It's that simple, bro. We knew that the market wanted to go down. We saw that we balanced out price to the upside. There's no more imbalances to the upside. The last imbalance was right here. That's a perfect entry because there's no more imbalances to the upside and you want the market to go down. We filled the last imbalance, boom, we're gone. So that is how to use a fair value gap as an entry, and I gave you a sneak peek of a future lesson just because I couldn't contain myself. But that is the use of a bearish fair value gap. I'm going to show you use of a bullish fair value gap. It's the exact same thing, just the opposite direction. And like I said, if you already know what a fair value gap is, that what I just told you about price being balanced, most people don't use that. So make sure you understand what I just said there and utilize that, bro, because a lot of people don't use that. But that right there, remember I told you there was 3 moments where like my trading changed instantly? That was one of them. That was the second one. Like that's just, it just makes logical sense. If you know if the price moves to fill imbalance or take liquidity, why would you assume we're going to trade to already balanced price action when the draw on liquidity is whatever direction you think it is? It just makes sense, bro. So now I'm going to show you a use of a bullish fair value gap. So I'm going to say this every lesson just because I need it burned in your brain. Oh wait, no, yeah, I'll show you that later because I need to show you use of a bullish. But I'm going to say it every lesson because I need it burned in your brain. Everything that I teach you, every concept that I teach you is literally nothing without draw on liquidity. If you don't understand where the market's going to go, nothing that I'm showing you matters. We're going to get to the draw on liquidity lesson, but I'm going to keep telling you. Like, I'm about to show you bullish fair value gap, and I'm going to tell you, just like how I told you in the bearish example, we need to draw on liquidity, or it doesn't really matter. You know what I mean? So just keep that in mind. If you are new and you don't know what draw on liquidity is, just be patient. Just take this for what it is. But it's all going to click once I show you what draw on liquidity is. But this is an example of a bullish fair value gap. So We swept this low, high time frame low. There is a higher time frame low here. That's my end of the week draw on liquidity, but I assumed we wouldn't come for it. I assumed we would save it for the rest of the week. I did not think we would push this hard, but that doesn't matter. Just assume that you knew our draw on liquidity was higher off the sweep. So I'm not going to go through the analysis of like, actually, yes, I will. I absolutely will. Let me find the draw on liquidity to the upside. So on a dump like this, like I said in the premium and discount example, on a dump like this, we put in a range. So if you didn't watch the premium and discount example and you don't understand premium and discount, make sure you go watch it. But even if I didn't think we would push all the way down to here, even though I wanted it, I didn't think we would push down to here today. This is today's price action, by the way. I didn't think we would push down here today. So my assumption was we would sweep this and then get some sort of pullback. But even if, right, we got a pullback and then we continue to dump, my draw on liquidity once we get this sweep and we start to pull back is equilibrium of this range. Because, like I told you in the premium discount video, after this dump, unless we just absolutely sell off, which there's very rare scenarios where that happens, after this dump and the sweep of this liquidity, the market cannot continue to sell off until we get back to equilibrium. Like, obviously we didn't sell off, but if we were going to, it would not have happened unless we came back to equilibrium. It won't happen, bro. You can look through price action and you'll find it yourself. Unless there's just like super one-off scenarios, we will come back to equilibrium before we continue a direction. So in this scenario, after the sweep, and you saw that we're starting to displace from it, your draw on liquidity can be equilibrium of this range. So let's assume that's what we were aiming for, and then I'll show you how we can use the fair value gap to get to it. So this line is equilibrium of this range. Look how we interact with it, bro. Oh my, like, I'm so wet. God, I'm wet. Ah, trading makes me wet, bro. I'm not gonna lie. When things just work how they're supposed to, I get really moist on my downstairs, bro. Gosh. All right, but yeah, let me lock in. My bad. So we got the sweep, and remember what I told you on the bearish example? It's a 3-candle pattern. Now we're just flipping it. So your 3-candle pattern here is, this is candle 1, this is candle 2, this is candle 3. Your fair value gap is going to be, this one doesn't have a wick, but the wick of the first candle, the top wick of the first candle, and the bottom wick of the third candle, the space in between those is your fair value gap. So boom skis, there's your bullish fair value gap. And like I said, it's nothing without drawn liquidity. In this scenario, we got a high time frame sweep. We want the market to see equilibrium of this range we just put in before we sell off again. That is your drawn liquidity. So right here, get in on this bullish fair value gap, stops below the order block, or stops. When you use a fair value gap, the basic rule of thumb is that you put the stop loss under the, I guess you would call it the first candle of the 3-candle pattern. So this is candle 1, this is candle 2, this is candle 3. Your stop loss would go below candle 1 because we can wick through fair value gaps. Like if this wick came all the way down and past this and then came back in but didn't close through it, that's still a valid fair value gap. But if we wick past the low of the first candle, if we wicked below this, that would invalidate this fair value gap. So you want your stop loss to be somewhere where your idea is invalidated. The idea of the fair value gap here would have been invalidated if we pushed below this wick. So that's where your stop loss goes. You're aiming for equilibrium. Here it is. Boom. 3.5 risk reward delivered in 4 minutes. So fair value gap wise, doesn't really get much more complex than that. Obviously, like I said, every concept that I use, I'm a low time frame trader. All my entries are on the 1 minute, but if you can use these things on the 15-minute and above for your bias. So like using it on the really high time frame, like 4-hour daily and weekly, that's where the institutional order flow comes from. We'll have a class on that. If you don't know what I mean, we'll have a class on that. But that's where you really need to pay attention to like fair value gaps on high time frame. So, ow, dude. Let's find a good example. Actually, I'm just going to show you the 15-minute on Flake searching. And now my neck hurts so bad out of nowhere. But, let me find a good example. Look how we've been moving lately, bro. Let me find a better set of price action to show you what I'm saying. Just a normal week. So here's a good example. So this is a 15-minute fair value gap. See the first candle? It's a 15-minute bullish fair value gap. It's a 3-candle pattern. Here's candle 1, candle 2, candle 3. Bottom wick of the third candle, top wick of the first candle. That's your fair value gap. So it's on the 15-minute. I'm not entering off this because, like I said, I enter on the 1 minute. But I can now use this for my bias. Let's assume this high here, since that's what we attacked. Let's assume that high was our drawn liquidity for whatever reason. Us filling the 15-minute imbalance, that's where we want to look for an entry. That's how you use the higher time frame for your lower time frame. So on the higher time frame, like I said, we either move to fill imbalances or take liquidity. The odds of us moving all the way down to fill this little itty bitty imbalance and invalidating this fair value gap and invalidating this order block, it's just not going to happen. So the last imbalance that we're expecting to be filled on the 15-minute is this imbalance. So now you can use that on top of your drawn liquidity being up here to assume we're going to go bullish from this point because this should be the last imbalance that we fill. So now, as a low time frame trader, unless you're not going to be a low time frame trader, then that can be your entry on the 15-minute. But I'm a low time frame trader, so I would take that and I would look on the 1 minute and I would be looking to find my entry. So this is the same price action just on the 1 minute, and now we are within that 15-minute fair value gap. I'm not seeing a 1 minute entry unless you entered off this. But that's after we already took this high, so normally I wouldn't love that entry, but it's still the same idea. But yeah, if you use the 15-minute as your bias for the longs, then found this 1 minute fair value gap as your entry, stops below the wick of the first candle. And I mean, obviously this is like a mythical scenario. Like obviously it's going to be rare you find a freaking 10 risk reward in 3 minutes. Obviously there was earnings or something, but same idea, you know what I mean? And then the same for the bearish, obviously, but I can find a bearish example. So right here, 15-minute BPR, which we'll talk about in the first lesson of the core section. If you don't know the mentorship schedule, go look at the first video. You'll see it. But like I said, bro, look at the 15-minute. Let's assume our drawn liquidity to the downside. Let's assume it's this imbalance, this price void, whatever. Let's assume we're just drawn down for whatever reason. Above this fair value gap, is there any more imbalances? No, bro. Price is fully balanced above this imbalance. So this imbalance, you should be thinking this is the last move up because we are moving up to fill the last imbalance to the upside before we go down to my drawn liquidity. So now we're within this 15-minute fair value gap. You know that we just filled the last imbalance in the 15-minute time frame. If you are a high time frame trader, that can be your entry. But like I said, I'm a low time frame trader, so now I'm looking for my low time frame entry within that 15-minute fair value gap, because you can assume that's the last thing we're going for since price is already balanced above this 15-minute fair value gap. So here we go. Here's your 1 minute fair value gap coming out of the 15-minute fair value gap that we already filled. You go short on it. Dang, bro. Yeah, you go short on it, and like I said, your stop loss is always going to be above or below the first wick of the 3-candle sequence of the fair value gap. So stops above the top wick of the first candle, second candle, third candle, stops above the first wick or the top wick. And like I said earlier, the candle can wick out outside of the fair value gap, but it can't close outside of the fair value gap, and it can't come above the top of the first candle's wick. Otherwise, it's invalid. It didn't do that. It wicked out. It got close, but it didn't invalidate this fair value gap. This fair value gap got respected. And like I said, obviously this is like earnings or something stupid, but the same idea applies. It delivered whatever your drawn liquidity was in one candle. It's earnings, but all news typically is, unless it's just an outlier, like, what would be a good outlier? Like, I don't know, bro. But all news is, for the most part, is volatility. If the market was predisposed to go down, then the news volatility is just going to deliver us down. So even though it's like there was earnings and we dropped freaking 500 ticks in one candle, the market was going to go that direction anyways. The news just gave it the volatility to do so. But yeah, the same idea applies, and you can see how it applied from high time frame to low time frame. So just to repeat, everything that I use, every concept that I use it on the 15-minute and above for bias, and I use it on the time frames below that for entries. So that's all on fair value gaps. Let's go into new week opening gaps and new day opening gaps. They're pretty much the same thing. My phone is getting blown. Why is my phone getting blown up? What is loops? Jeez, man. What is loops? Who signed me up for loops? Alright. So yeah, let's get into new week opening gaps and new day opening gaps. I'm going to start with new day opening gaps since there's an example from today that I used for my trade. Like I said, we're covering every form of imbalances. So fair value gaps are like the typical imbalance that everyone talks about and uses. But new week opening gap and new day opening gap, it comes off as like a more advanced subject, but it's really not. So, wait. Oh, I'm tweaking. This is the gap. My bad. So, this is the new day opening gap high, new day opening gap low, and all a new day opening gap is, so basically at 4, is it 5? From 5 to 6, the market isn't being traded. Even though we're traded 24 hours, it takes a break, we're not traded. And sometimes when we go from the close at 5 into the open at 6, the market will gap up. So it leaves a section of price that is untraded. And like I told you, the market moves to fill imbalances or take liquidity. Like, we move to fill imbalances like this for value gap, because it's only been traded one direction. So we want to trade through the other direction to balance out price. Imagine how strong the market's attraction is to a section of price that hasn't been traded either direction, bro. Obviously, the market is going to want that, and it's going to want it very aggressive. I don't even have to tell you my entry. Look how aggressive we came for that at open, bro. And it happened earlier in the week too, I'm going to show you. But, in my opinion, I mean, you can look at the charts and verify it yourself. New day opening gaps and new week opening gaps are the strongest draw on liquidity ever. But, for the reasons I just said, it's a section of price that's literally untraded. The market wants that. So, I'm not going to go, because I'm going to go over a new day opening gap and new week opening gaps again. I'm just going to cover it in a sense of it being an imbalance. Because there's more to it. Like, after we've already filled it, we can come back and interact with it again, and you'll see how, like, the market plays with the low and the high of the new day opening gap, even after we've already filled the imbalance. But I don't want to cover that now. I want to cover that later. Right now, I just want to cover it as an imbalance. So, like I said, this right here, this was the close at 5. This was the open at 6. A section of untraded price action. Then we get to New York Open. I'll show you again how we incorporated the fair value gap. But like I said, it's a section of untraded price action. Every time I see that going into the open, I assume that we are going to go fill that very aggressively. I mean, we wasted no time at open, bro. 9:30 open, immediately. Pretty much no retraces, very minimal retraces just to fill these fair value gaps, and then just delivered, bro. So, these were the fair value gaps we used in the examples. You know that this is a section of price that's untraded, and you know that the market's going to want it. You know that above this gap, like we said, price is already fully balanced, and you know this is the last imbalance to the upside before we get to this new week opening gap. That's your entry. Very simple, bro. I mean, you can put it up here, but I would be putting it above this order block. We'll talk about order blocks later on, but that's where I'd put it. And then you can take profits along the way, obviously, but like this is your ultimate delivery. We wasted no time to go fill this new day opening gap, bro. Like I said, we'll talk about how, like, you can see how we wick at the high. We'll talk more about how the market interacts with it after it's already filled. But right now, purely as an imbalance, that's as simple as it is, bro. That's as simple as it gets. Price, or the market closed at 5, opened up at 6, and gapped up or gapped down. So that left a section of price action that hasn't been traded through yet. If you see that going to New York Open or whatever session you trade, I mean, for me, I trade New York session open, so that's what I know. Assume we're going to go get that aggressively. And if we don't get it as soon as we open, we're going to get something else, and then we're going to deliver to it aggressively. I mean, backtest yourself, pay attention to it yourself. Market wants to fill in imbalances. That is the greatest form of imbalance that there is. A section of price that's untraded. So, and the difference between a new day opening gap and a new week opening gap is what you'd assume. And a new day opening gap is going to happen like in the middle of the week. So the market closes on Friday and opens up again on Sunday. So a new week opening gap is going to be the gap up or gap down from the close on Friday and the open on Sunday. A new day opening gap is just going to be any day between the week. It's the exact same thing. It's just any day between the week it happens. So like this was the gap up from Wednesday to Thursday. So I'll show you the new week opening gap I used on Monday. Oh wait, did I already pass it? Yeah, I did, I guess. Here it is. So, it's a down close candle. So that's the close of that candle. That's the new week opening gap low. And like I said, the difference between a new day opening gap and a new week opening gap is that the new week opening gap is the gap up at the start of the week. So the market closed on Friday here and opened up on Sunday here. So this is your new week opening gap. And it's the same idea as a new day opening gap, bro. We want to fill this. It's a section of price action that's untraded. We want to fill it. And look at the precision on this one, dude. I have a screenshot of me taking this trade. I literally top ticked these shorts. But like you can see how clearly like this, we were targeting this new week opening gap, dude. We came down, filled it pretty much perfectly, and then went away. We came down here for the sole purpose of filling this new week opening gap. Literally as soon as market opened, bro. Market opened, manipulated, swept out these highs, convinced people we wanted to go long so that we can go short with big money, and then we just immediately sold off this new week opening gap. The market wants to fill imbalances, bro. It's that simple. And like I said, there's not much of a difference between new week opening gap and new day opening gap. It's just new week opening gap is the start of the week. That's literally it. And like I said, obviously, there's more to new week opening gap and new day opening gap than what I'm telling you. Right now, I just want to talk to you about its imbalance factor and how the market wants to fill that imbalance. So, in that sense, it's as simple as what I just said, bro. So, that's the second part. And the last part of imbalances I want to cover is price voids. So, let's find a price void. Here's one. I'll find a couple of examples, but this is one right here. And it really is the same thing as a new day opening gap, except it just happens on lower time frame candles. And it doesn't happen at like a specific time, you know what I mean? But price void is literally just when a candle closes and a new candle opens, it leaves a section of untraded price action. It'll act pretty much as a fair value gap is how you should look at it. Price, usually when this happens, the candle that gapped will immediately go fill it. Like you can see this candle went and immediately filled it. But later on, you can expect it to support price as well. Like you can see this candle supported price, and then we started a descent. So, I mean, it's still, like I said, it's still the idea of price wanting to fill an imbalance. When this candle closed and this candle opened, it left a gap. We went and filled the imbalance, and then, like how I said about new week opening gap, and how we'll talk about it more later, and how it still supports price even though it's already filled. That's pretty much what happened here with this price void. But like I said, we'll talk more about that later. I just want to talk about these concepts and the fact that they are imbalances in the market. So the gap from this close and this open, that gap right there is a price void, and we will always pretty much fill it as soon as the candle opens. So let me see if I can get one more example. I also want to get an example on high time frame. I mean, there's one right here. You can see it. We obviously went and crushed it, but let's see high time frame, because it happens on the daily too, but it's not like, or let me find that really. It doesn't happen super frequently. It happens frequently on the lower time frame, but like I said, on lower time frame, we typically like go fill it in as soon as it forms. So, and this is a new day opening gap, so can't use that. But yeah, I mean that's pretty much what it is. That 1 minute example I showed you. It's really I don't use it too frequently. You'll see it happen. Well, when you see it happen on the daily, obviously it's a new day opening gap, but you'll see it happen. And like I said, we really just go and fill it in immediately. I don't use it for entries frequently. I pay attention to it. Like here, because we're so deep in a discount, I would have never used this for an entry. But when it forms, I'm looking at it. I see the price void. I pay attention to how price is supporting here, or yeah, how price is like deflecting here off this price void. I'm seeing how it interacts. So price voids are probably the least important out of all the three I just showed you. Well, not probably, for sure. At least with the way I trade, price voids are the least important, but it's still important that you know it as an imbalance, and I want to introduce every imbalance that I know to you. So fair value gaps, new day opening gap, new week opening gap, and price voids. Those are the imbalances in the market. It's important that you know them, pay attention to them. The first two, the fair value gaps and the new day opening gaps and new week opening gaps, those are going to be extremely important. By the time we get through all this, you'll be using fair value gaps pretty much every day. And new day opening gaps and new week opening gaps, you'll be paying attention to them every time they form. They don't form every day, but when they do form, you will be paying attention, just because you'll notice how consistently the market targets it. But yeah, man, I mean, that was a crazy yap session, but that's all I got for you guys, bro. I feel like that was a pretty good session. If you are newer, if you know like a little bit of ICT, I feel like this is probably gonna help you step up a little bit. But yeah, man, I mean, pretty good session in my opinion. If you made it to the end, bro, go in the comments and say something wicked, bro. Say something crazy, like say more I want to touch you if you made it to the end, and I'll know that you made it to the end, and I may accept your request. But yeah, man, good yap session. I like this class. If you guys haven't been paying attention to any of the classes, I think this is one of the ones that you definitely should be. But yeah, man, day 4 in the books. I'll see you guys on day 5. We going crazy.